Topic of today's video is the 10 golden rule of investment. So what is an investment? An investment is an asset or item acquired with the goal of generating income or appreciation. Appreciation refers to an increase in the value of an asset over the time. When an individual purchases a good as an investment, that intent is not to consume the good but rather to use it in the future to create wealth. An investment always concerns the outlay of some resource today, time, effort, money, or as an asset, in hope of generating payoff in the future than what was originally put in. For example, an investor may purchase a monetary asset now with the idea that the asset will provide income in the future or will later be sold at a higher price for a profit. Investing can be often break down into few simple rules that investor can follow to be successful. But success can be as much as what to do as it what not to do. On the top of that, our emotions throw a wrench into the whole process. But everyone will know that you need to buy low and sell high. Our temperament often leads us to sell low and buy high. So it's key to develop a set of golden rules to help you guide you through the time. Anyone can make money when the market is rising, but when the market gets choppy, investors who succeed and thrive are those who have a long-term plans that works. Here are 10 golden rules of investment. We are going to describe each one with an explanation. Rule number 1 is never lose money. Let's kick it off with some timeless advice from the legendary investor Warren Buffett, who said, rule number 1 is never lose money, and rule number 2 is never forget rule number 1. The oracle of Omaha's advice stresses the importance of adding loss in your portfolio. When you have money in your portfolio, you can make more money on it, so a loss hurt your future income power. Of course, it's easy to say that not to lose money when Buffett's rule essentially means is don't become enchanted with an investment potential gain, but also look for its downside. If you don't get enough upside from the risk you are taking, the investment may not be worth it. That's the one reason many investors are avoiding long-term bonds now. Focus on the downside first, consoles Buffett. Rule number 2 is think like an owner. Think like an owner, says Chris Graff, co-chief investment officer at RMB Capital. Remember that you are investing in business, not just stocks. While many investors treat stocks like gambling, real businesses stand behind the stocks. Stocks are fractional ownership interest in a business, and as a business performs well or poorly over the time, the company stocks is likely to follow the direction of its profitability. Be aware of the motivation when investing, says Christopher Miser, CEO of Beverage Capital in LA, Jolla, California. Are you investing or gambling? Investing involves an analysis of fundamentals, valuation, and a position how to treat the business will perform in the future. Make sure the management team is strong and aligned with the interests of the stakeholders, and that the company is a strong financial and competitive position, says Graff. Rule number 3. Stick to your process. The best investors develop a process that is consistent and successful over many market cycles, says Sam Handels, president of Sterling Investment Partners. Don't deviate from the tried and true, even if there are short-term challenges that cause you doubt yourself. One of the best strategies of investors is a long-term buy and hold approach. You can buy stocks from the regularly in a 401k, for example, then hold in for decades. But it can be easily when the market gets violent, then deviate from your plans because you are losing money temporarily. And advice is don't do it, don't lose your hope and focus on your target. Rule number 4. Buy when everyone is fearful. When the market is down, investors often sell or simply quit paying attention to it. But that's when the bargain and out is drop. It's true that stock market is the only market where the goods go on sale and everyone is too afraid to buy. As Buffett has famously said, be fearful when the others are greedy and greedy when others are fearful. The good news if you are a 401k investor is that once you set up your account, you don't have to do anything else to continue buying it. The structure keeps your emotions out of the game. Rule number 5. Keep your investing discipline. It's important that investors continue to save over time in rough climate and good even if they can put away only a little. By continuing to invest regularly, you will get in the habit of living below your means, and even as you build up a nest egg of the asset in your portfolio over time. The 401k is an ideal vehicle of the discipline because it takes money from your paycheck automatically without you have to decide what to do this. It's also important to put your investors skillfully. Here's what to select your 401k investment. Rule number 6. Stay diversified. Keeping your portfolio diversified is important for reducing risk. Having your portfolio in only one or two stocks is unsafe, no matter how well they performed for you. So expert advised spreading your investment around in a diversified portfolio. If I had to choose one strategy to keep in mind when investing, it would be diversification, says Mindy Yu, former director of investment at Stash. Diversification can help you better weather the stock market up and down. The good news diversification can be easily achieved. An investment in a Standard and Poor's 500 index fund, which holds hundreds of investment in America's top companies, provide immediate diversification for portfolio. If you want to diversify more, you can add a bond fund or other choices such as real estate fund. They may perform real estate fund that may perform differently in various economical climates. Rule number 7. Avoid timing the market. Experts routinely advise clients to avoid trying to time the market, that is, trying to buy or sell at the right time, as in popularized in TV and film. Rather, they routinely refer to saying, time in the market is most important than timing the market. The idea here is that you need to stay invested to get strong return and avoid jumping in and out of the market. And that's what Veronia Willis, an investment strategy analyst at Wells Fargo Investment Institute, recommended. The best and worst are typically close together and occur when markets are at their most volatile. During a bear market or economic recession, an investor would need expert precision to be in the market one day, out of the market the next day, and back in again the following day. Experts typically advise buying regularly to take advantage of the dollar's cost averaging. Rule number 8. Understand everything you invest in. Don't invest in a product you don't understand, and ensure the risks have been clearly disclosed to you before investing, says Chris Rowley, founder and CEO at Harvest Return, a fintech marketplace for investing in agriculture. Whatever you are investing in, you need to understand how it works. If you are buying a stock, you need to know why it makes sense to do and when the stock is likely to be profitable. If you are buying a fund, you need to understand its track record and cost, among other things. If you are buying an annuity, it's vital to understand how annuity works and what your rights are. Rule number 9. Review your investing plan regularly. While it can be a good idea to set up a solid investing plan and then only tinker with it, advisable to review your plan regularly to see if it still fits your need. You can do it whenever you check your accounts for tax purposes. Remember, thought your first financial plan won't be your last, says Kevin Driscoll, Vice President of Advisory Service at Navy Federal Financial Group in the Pensacola area. You can take a look at your plan and should review it at least annually, particularly when you reach a milestone like starting a family, moving, or changing jobs. Rule number 10. Stay in the game, have an emergency fund. It's absolutely vital that you have an emergency fund, not only to tide up during the tough time but also when you are investing long term. Keep 5% of your asset in cash because challenges happen in life, says Craig Krishner, President of Retirement Plan Services at Stochert Estate Planning Wealth and Advisor in Pompano Beach, Florida. He said, it makes sense to have at least 6 months of expenses in your savings account. If you must sell all of your investment during a rough spot, it's often likely to be when they are down. An emergency fund can help you stay in investment game longer. Money that you might need in short term, less than 3 years, needed to stay in cash, ideally in a high yield online saving account or perhaps in a CD. Shops around to get the best deal. The bottom line is investing well is about doing the right thing as much as avoiding the wrong things, and aimed at all of that. It's important to manage your temperament so that you are able to motivate yourself to do the right things even as they may feel risky or unsafe.